So because learning objective 3 was so long, I broke it up into two separate videos. So before you start this video, make sure that you've watched learning objective 3.1 for the chapter 3 videos, and then pick up with this one, and we'll finish up learning objective 3 and cover learning objective 4. So we've in learning objective, what I call 3.1, we did the adjusting entries for the deferrals. So now we're going to do the adjusting entries for the accruals. So when we talk about an accrued expense, this is an expense that we have incurred, but we haven't yet paid and we hadn't recorded yet. And normally we wouldn't record it except that it's the end of the year. And so I need to record it so my financial statements can be complete. So these are things that I have to go in and accrue or record before I do those financial statements. So a common one is for salaries. So typically we don't record how much we owe our employees every day that they work. We wait to the end of the pay period and then we record all of the salaries that we owe at once. But what happens when our pay period falls in or the end of the year falls in the middle of the pay period? So here at Smart Touch Learning, we pay our employees on the 15th and the 1st. Okay, now let me just go ahead and say any company that pays on the 1st, that was not set up by an accountant, and your accountant hates you. Okay, so if you're going to own your own company and you're going to set up your own company, you want to pay on the last day of the month, not the first day of the month. Okay, but Smart Touch Learning didn't consult an accountant when they set this up, and they pay on the 1st. So here it is, December 31st. We paid our employees on the 15th. If you remember, we did that journal entry back in chapter 2. And they get $2,400 a month. So on the 15th, we paid them $1,200. And then on January 1st, we're going to pay them $1,200. But here it is, December 31st. I know that I owe my employees. I know that I'm going to pay them tomorrow, but if I just leave it off and pretend like I don't owe them, then I will be understating my expenses and my liabilities because I have this debt to my employees. And again, the SEC and the FASB frown on understating your expenses and your liabilities. So I need to record today on the 31st that I owe my employees $1,200 for the second half of the month, even though I'm not going to pay them till tomorrow. So if you remember, on December 15th, we did this journal entry in chapter 2. We owe them their salaries, so we went through and debited salary expense and credited cash to show that we paid our employees. Remember, debits are listed first, credits are listed second, and credits are indented, right? Now, technically, this isn't how payroll runs. It's not quite this simple, but we're not going to talk about payroll a whole lot in this course, and the little bit that we are going to talk about, it's going to come in chapter 11. So we're just going to pretend for right now that we don't have to actually do payroll taxes and all that kind of not fun stuff. Now, on December 31st, I know that I owe my employees $1,200 for the second half of December, but I'm not going to pay them yet. I'm not going to pay them till tomorrow. So instead of crediting cash, I have to credit a liability to show that I owe them this money. So I'm still going to debit salary expense for $1,200, but I have to credit now the liability salaries payable. Remember, liabilities have a normal credit balance, so I'm going to credit salaries payable to show, hey, I owe them $1,200. And this way, when I do my financial statements, my liabilities will be correct and my salary expense will be correct. So now salary expense shows all of the salary expense for the year, and salaries payable correctly shows that I owe my employees $1,200. Now, on January 1, tomorrow morning, when I come in the new year, I'm going to pay those employees. So I want to reduce the liability to take it off of my books. So since liabilities have a normal credit balance, I want to debit the liability to take it off of my books, and then I'll credit cash because I paid them the $1,200. So now salaries payable, if you're recording it in your T account, has a zero balance because I've paid them, I don't owe them anything, and cash has been decreased as well. Now, another example would be interest. And again, we're going to talk about interest much more in a later chapter in chapters 11 and 12. So we're just going to touch on interest a little bit here. But if you remember on December 1st, we did this back in chapter 2, we bought a building for $60,000, but we didn't pay cash for it. We borrowed the money. We took out a 1-year loan that has a 2% APR or annual percentage rate. Okay, so back in chapter 2, when we did this entry originally, we debited building because it's an asset, and we credited note payable to record the liability that I owe on this. So building's an asset with a normal debit balance, liability, note payable, pardon me, is a liability with a normal credit balance. So I've increased both my building and my debt to show that I owe this. So interest is accruing on this. Now let me say something here. You and I, when we borrow money, whether it's to buy a car or a house or something like that, we're typically going to make monthly payments, and a portion of that monthly payment is going to go towards the interest, and a portion of that monthly payment is going to go towards the principal. And you and I are paying what's called compound interest, where we're accruing interest on the interest and that sort of thing. We're going to get to that in chapter 12. So just for simplicity's sake, pretend with me that in this world, we're not making monthly payments. We borrowed $60,000 and we're not going to make monthly payments. And 1 year, in December 1st of next year, we're just going to pay back all $60,000 and all the interest that had accrued on that $60,000. Okay, this just makes our journal entries a little easier, and it makes our calculations a little bit easier. So we're calculating what's called simple interest, and simple interest is the principal times the interest rate times the time. Now the key here, the principal is the amount of money you borrowed. So in our example, it's $60,000. The interest rate is an annual interest rate. Remember, it was 2% annual interest rate. So since the interest rate is an annual interest rate, time must be expressed in terms of a year. We're not computing the interest for the whole loan. We're only computing how much interest has accrued thus far. Meaning, if I were to walk into the bank today and say, hey, I want to pay off the loan early, I wouldn't have to pay the whole year of interest. I would just pay how much interest has accrued or has earned on that so far. So in our example, the principal is $60,000. The interest rate is 2%. Remember to convert a percent to a decimal. You move the decimal 2 places to the left. And only 1 month has passed since November 1st when I bought the building and December 31st. So the time is 1/12. So that means at this point in time, I owe $100 of interest. So again, if I were to walk into the bank today and say, hey, I won the lottery, I have a bunch of money, I want to pay off my debt, they'd say you owe me $60,000 plus $100 in interest. Okay. So I need to record that I owe this $100 of interest, even though I'm not paying it today, even though I'm not going to pay it until December 1st of next year when I actually go in and pay off the loan. But I still owe it. So for completeness sake, I have to record it. So remember, all adjusting entries involve an income statement account and a balance sheet account. So this interest would be interest expense. Okay, and then since I owe it, it would be interest payable. So interest expense is my income statement account. And remember that we always debit expenses. And interest payable is my liability account. So I'm going to debit interest expense to increase that expense account. And I'm going to credit interest payable to increase that liability to show that I owe that debt on the building. Now, one thing I wanted to point out, notice that I don't credit note payable. Okay, the interest and the note are kept in separate accounts. So the note is just going to have the $60,000 of principal, and then the interest payable account is kind of like its partner account that shows how much interest has accrued on that. So the interest and note are kept in separate accounts. Now, an accrued revenue happens when we've done work for a customer that we haven't been paid for yet, and we're not expecting to be paid for just exactly yet. Okay. So in this example, we're told that we were hired on December 15th to perform some e-learning services. We were going to start the next day on December 16th. The customer is going to pay us $1,600 a month, but they're going to pay us at the end. So we're not going to get paid until January 15th. They're not paying us in advance, they're paying us at the end. So on December 15th, when I signed the contract with this customer, I do not record a journal entry. They haven't given me any money. I haven't done any work. There's nothing to record. But here it is December 31st, and I've been working for 15 days now since the 16th, and I've earned half of my monthly payment. I've earned half of the 1600. Now the customer has not paid me. They're not going to pay me until January 15th, pardon me. But I have still earned it. So I want to record that revenue that I have earned. So on December 31st, I want to do a journal entry where I credit service revenue to show that I've earned half of that, or $800. Now, I have not gotten cash yet, but I'm expecting to get it in the future. The customer has given me their promise. So my debit will be to accounts receivable. Remember, accounts receivable is an asset account. It shows the amount of money that we're expecting to receive in the future. So I am expecting to receive this, not today or tomorrow, but I am expecting to receive it. And now I've recorded how much service revenue. So that if I were to look at my service revenue T account, again, it would correctly show how much work I have done this year. Even though I haven't gotten paid for it, I have done the work. So now again, my service revenue account correctly shows how much work I've done, and my accounts receivable account correctly shows how much money I really am expecting to collect in the future. Now, on January 15th, when the customer pays me, let's think through this one for a minute before we start writing things down. So on December 15th, the customer is going to bring me a check for $1,600. So when a customer gives me a check, I'm going to debit cash for $1,600, right? So I'm going to debit cash for $1,600. Now I want to credit accounts receivable because I want to show that, hey, this customer doesn't owe me any money anymore. They've paid me everything they owed me. So the tendency is to credit accounts receivable for $1,600. Okay, but I'm going to flip back now in the slides. Let's go back to our well, I'm not going to flip back. It's not going to let me. If you look back in your accounts receivable T account, you've just debited accounts receivable for $800. So a rule of thumb is you can't credit accounts receivable for more than you had previously debited it. If you credit it for $1,600 and you had only debited for $800, it's going to look like the customer overpaid you, like you owed them money. You don't owe them any money. They didn't overpay you. So I want to credit accounts receivable for just the $800 that I had previously debited it for. Now, debits have to equal credit. So at this point in our journal entry, we have a debit to cash of $1,600, a credit to accounts receivable of $800. I need another credit to balance this out. Well, that other credit is to service revenue. That shows the second half of the work that I've done. So the credit to service revenue shows the work that I did January 1 through January 15, and the credit to accounts receivable shows the work that I did in December. So I've debited cash, credited service revenue, and accounts receivable. And again, our cardinal rule is that debits have to equal credits, and so this equation balances here, so I feel good about this one. Now, the last thing that we need to do before we're completely done with this is we're going to do what's called an adjusted trial balance. So an adjusted trial balance is just like the trial balance that we did back at the end of chapter 2 and the beginning of chapter 3, where we're going to list all of the accounts and their balances. But now we're using the adjusted balances. We have the correct updated amounts. So you'll notice that office supplies is correctly reported at $100. Prepaid rent is correctly reported at $2,000. Notice that we have accumulated depreciation on our furniture here. We also have it on our building. We skipped that entry just for time's sake. Notice that we have the interest that we owe in interest payable. We have the salaries that we owe in salaries payable. We have the we have the interest expense, pardon me, down here of what we owe in interest. So these numbers are the updated numbers, and these numbers are the numbers that we're going to take and go forward with to do our financial statements. So where we pick up in chapter 4, we're going to pull out the same adjusted trial balance, and we're going to go through and prepare our 3 financial statements: the income statement, the statement of retained earnings, and the balance sheet. And once we get those financial statements prepared, then we're going to do the closing entries to close out the books. And so then we'll be ready to start over tomorrow, January 1, with our correct balances. So by the time we finish chapter 4, we'll have gone through an entire what we call accounting cycle. Think of it as a year's worth of accounting we'll have gone through.